Is Apple still a buy, or should you wait for a better price? Today, we're diving deep into a company that needs no introduction. Apple just closed out its fiscal year 2024 with a solid earnings report, but the market's reaction was underwhelming to say the least. And here's where things get interesting. While Apple posted solid results, legendary investor Warren Buffett has sold off a major part of its Apple stake. In this video, we'll uncover the real story behind Buffett's big sell-off, look into Apple's recent earnings, break down the state of its business, and reveal what this all means for investors as we head towards 2025. Is Apple a buy, a sell, or a hold at this critical moment? Alright, let's address the elephant in the room. Warren Buffett's significant reduction in his Apple position. Berkshire Hathaway began the year with an astounding 905 million Apple shares, a stake that represented a massive $170 billion at its peak. But Buffett has taken big steps to reduce that stake. Here's what happened. On August 3rd, Berkshire Hathaway announced it had sold 49% of its Apple stake in the second quarter. Then on November 2nd, the company disclosed another 25% reduction in its holdings, leaving Berkshire with about 300 million shares. This is a big move, and naturally, it has investors wondering, is Buffett losing confidence in Apple? Here's the thing. Buffett has long called Apple one of his best investments, praising its loyal customer base and solid fundamentals. But Apple had grown to represent almost 20% of Berkshire's portfolio. In the context of portfolio management, this reduction is likely a move to de-risk and rebalance, not a reflection of doubt in Apple's potential. So while Buffett's decision to trim his Apple position is notable, it doesn't necessarily mean you should jump ship. Instead, it highlights the importance of portfolio balance, especially with a stock that's already near all-time highs. Now, let's get into Apple's fiscal Q4 earnings. By most metrics, the company delivered strong results. Apple reported $94.93 billion in revenue, up 6% from the same quarter last year, and slightly beating Wall Street's forecast of $94.58 billion. Earnings per share came in at $1.64, a 12% increase over last year's $1.46, again surpassing expectations. Despite these positive numbers, the market barely reacted. Apple stock was actually down about 1% after earnings were released. This is what we call a shrug from Wall Street, where solid results just aren't enough to push the stock price higher. While Apple's global sales were impressive, there's one region that continues to underperform: China. Revenue in China was $15 billion, essentially flat and down about 0.3% compared to the same period last year. Apple is facing fierce competition in this market from domestic giants like Huawei, which is clawing back market share with their own high-end smartphones. Given the geopolitical tensions and the rise of local competition, China remains a challenging market for Apple. It's worth noting that a slowdown in China could pose a serious headwind for Apple if it continues, as China represents a significant chunk of its overall revenue. For investors, this situation is a potential risk factor that could affect Apple's growth trajectory in the coming quarters. On a brighter note, let's talk about Apple's services segment, a growing powerhouse for the company. Apple Services revenue grew by 12% in Q4, reaching just under $25 billion. Although it fell slightly short of Wall Street's $25.3 billion expectation, this segment is a crucial part of Apple's business. Services now make up roughly a quarter of Apple's total revenue, outpacing the growth rate of product sales, which rose by only 4% in comparison. From the App Store to Apple Music, iCloud, and AppleCare, these services carry higher profit margins than hardware sales. As more users sign up for Apple's subscription offerings, this revenue becomes more predictable and sticky, meaning users are less likely to switch to competitors. For Apple, it's an increasingly profitable, high-margin revenue stream that's essential to its growth. Now, let's discuss the latest buzzword in tech: AI. Apple recently dubbed this to Apple Intelligence and released it alongside its iPhone 16 series, which includes several AI-driven features. With this rollout, Apple is taking a more integrated approach to AI, focusing on privacy and on-device processing. It's a strategic move to keep users locked into its ecosystem, and if successful, it could drive more device upgrades. Some features in Apple Intelligence include a more advanced Siri that can summarize emails, transcribe calls, and even create custom emojis. But here's the twist: Apple is rolling out these features in phases. Some AI tools went live in late October, while others won't be available until December. Analysts say that this staggered launch may have weakened early iPhone 16 sales, with demand so far mixed. Only time will tell if Apple Intelligence can drive the iPhone 16's success. On a slightly brighter note, Apple is set to launch an AI-driven wall-mounted smart home device by March, marking its push into home automation. This move aims to regain ground lost to Alphabet and Amazon in the smart home market. In 2026 or 2027, Apple plans to debut a more ambitious tabletop device with advanced AI and robotics, signaling a deeper commitment to smart home innovation. With these developments, Apple aims to establish itself as a key player in connected home technology. If you're finding this breakdown valuable, don't forget to hit that subscribe button and give us a thumbs up. A healthy balance sheet is important for any organization, and Apple is no exception. From 2022 to 2024, Apple has shown steady financial growth, balancing increased assets with managed liabilities to support its strategic ambitions. Total assets rose from $352.8 billion to $365 billion, driven by gains in cash and short-term investments, which grew to $65.2 billion in 2024, enhancing Apple's liquidity and agility. On the liabilities side, Apple saw a rise in current obligations, reaching $176.4 billion in 2024, reflecting higher operational activity. However, it reduced long-term debt, lowering non-current liabilities from $148.1 billion to $131.6 billion. This careful debt management highlights Apple's financial discipline. Shareholders' equity grew from $50.7 billion to $57 billion, supported by gains in common stock and improved retained earnings. Apple's balance sheet reveals a company focused on sustainable growth, well prepared to seize future opportunities in tech. The story isn't all positive. Apple is also dealing with significant headwinds on multiple fronts. First up, the European Union tax ruling. Recently, the European Court of Justice upheld a $14.35 billion tax charge against Apple, which the EU says is owed due to state aid violations. This is a major financial setback, not only because of the tax itself, but also due to potential future implications for how Apple does business in Europe. And that's not the only legal issue. Apple also receives about $20 billion annually from Google for making Google the default search engine on iPhones. However, an antitrust case against Google could threaten this arrangement. If regulators force Google to reduce or eliminate these payments, Apple could lose a valuable revenue stream. So, with all this on the table, is Apple a buy, sell, or hold? If you're already holding Apple stock, the smart move may be to keep holding. Apple has solid fundamentals and consistently generates high cash flow. Its shift to services and AI innovation positions it well for long-term growth, even if the stock is near a high valuation. Now, if you're thinking about buying Apple, here's where you need to be cautious. The stock's price-to-earnings growth ratio is around 3, which is relatively high. With revenue growth expectation in the low to mid-single digits for the next quarter, and uncertain results for Apple Intelligence, it might be wise to wait for a price dip or for more clarity on the company's AI performance before jumping in. Finally, selling Apple could make sense for investors who are cautious about its high valuation and ongoing challenges. If you're looking to take profits or reinvest in stocks with potentially higher growth, selling might be worth considering. However, given Apple's strong fundamentals, this is a choice mainly for those wanting to lock in gains. To wrap it up, here's the bottom line. Apple is a company with fantastic fundamentals, a strong services segment, and promising AI initiatives. But Warren Buffett's recent sell-off, the company's challenges in China, and the EU regulations serve as a reminder that no stock is without risk. What do you think? Are you holding, buying, or selling Apple right now? Let us know in the comments below. Don't forget to subscribe for more deep dives and market analysis. Thanks for watching, and as always, happy investing.